Hello, Facebook. It's been about a week and a half. Sorry, it's been a delay. Welcome to the 39.6 show. This is the Facebook Live show where we discuss how to make your money work for you so you don't have to work for your money. Today's topic, married filing separately versus married filing jointly. Take it away, Pinky.
Hey, let's get moving. Come on, and spin around with me. I love dancing. Dance now.
All right, Pinky. All right, so welcome to our new digs. I'm hoping this lighting is working out. It might be a little dark in the background, but you can see a pretty cool high rise in the background, and you can see pretty cool. I think that, yeah, you can see the pool lighting over there. All right, pretty awesome. So, all right, just checking. Can you just confirm you can? Okay, thank you, Kate. Loud and clear. Okay, so yeah, this is going to be episode number 20, I believe. Yes, Facebook episode 20, taxes episode number 6. We will be discussing married filing separately versus married filing jointly. Okay, so Shanola, thank you, Shanola, for letting me borrow your toy. Pinky's always fun. She missed out on episode number 19, but she's back for today. And we went shopping at IKEA, and Shanola said, Daddy, please buy me this beach frame. You're going to find an awesome use for this for your next episode. And lo and behold, we did. Okay, so yeah, it's been about a week and a half. We've been going through a lot of transition over here on our end. So sorry for the delay. We also filed 3 business tax returns. They're due Saturday. I don't know if technically they're due Saturday. September 15th is like the extension date for business filings. I don't know if they could be due Saturday, if they're really due Monday, if there's a delay because of the weekend. But anyway, they got filed like yesterday. So that was a big, huge load off. Next year, we won't be waiting until September to file our business filings. Our personal return is still not done yet, but that's not due till October 15th. And frankly, that's like super easy in comparison to the business filings. I can basically do that stuff on paper by hand without the forms. And I'm going to basically show you how to do that today, at least the brackets portion. The taxes actually isn't really that hard. Okay, but this is a common question that I hear people asking about married filing separately or married filing jointly. Okay, and back in episode 15, we discussed how progressive federal taxation works. Okay, and so if you haven't seen that episode, please check that one out. So I'm so glad to see a few people have checked in. If you're there, just give me a thumbs up or a hello. And why don't you guys say where you're watching from? That would be pretty cool. It's always cool to see where people are coming from. Sometimes people are doing live episodes and people are watching from overseas or Alaska, and that is always pretty awesome. Okay, so married filing jointly and married filing separately. So what we are going to first do is I'm going to show you this bead frame, okay? And hey, Julie Lamb, welcome. Thanks for coming. You are our first commenter other than my wife in the next room. Thank you. And yes, we are in DFW. This is actually the new Ardan Apartments. You can actually see behind me, I'm kind of going the wrong way, but that's like a big high-rise tower right across 75. And we are so glad we got this unit here. This place just opened up a month ago, and we are like the 10th tenant in here. So we're pretty happy. We get to use all the amenities like to ourselves. So it's pretty fun. The pool is basically always empty. Okay, so without further ado, hi, Chris. Thank you for saying hello. This is our federal tax bracket progressive system, okay? And what we have here, okay, I'm going to move these guys here to the side, okay? We have basically the brackets, and we have the different amounts that fill up each bracket, and each of these beads is equal to $10,000. Okay. Now I have this set up for married filing separately right here, but as an FYI, if you're single and not married at all, it's almost exactly identical to this. There's a little bit of a difference at the higher tax brackets up at 35%. And the 35% one gets a little bit larger. But in general, it's exactly the same up to that point, okay? So how this basically works, now the new tax brackets for 2018 are lower than last year, okay? And so some people wondered, what's 39.6? That's named after the previous tax brackets, and that was the highest bracket, 39.6. That's where the number came from. I got the URL back before they changed it. So anyway, that's what my blog is named after, or my show is. But now it's really 37%. I just didn't feel like changing the name. Now, most people in 2018 are going to be taking the standard deduction, and that's kind of a different episode. But the simple way to say it is basically everybody will be taking the same amount of standard deduction. And that amount equates to the 0% bracket. Okay, so if you're single or married filing separately, it's $12,000. And if you're married, well, and filing jointly, it's $24,000. You just double it. Okay, but we'll focus on just the single side. So we're rounding off the numbers to make this a lot easier. So let's just call it a $10,000 standard deduction. Okay, I'll make this a little closer. And so that basically means that you have $10,000 of income that does not get taxed. That is what I call the 0% bracket. Now, if you ever look up the tax brackets, they will show you the brackets based on what we call taxable income. Well, you would have to always subtract your standard deduction first. So I try to make it simpler. Just assume this is how much money you earn. The first $10,000 you earn will be here at the 0% bracket, okay? The next $10,000 you earn would be at the next bracket, which is the 10% bracket. Okay, so if you've earned $20,000 in a year, you're not paying any tax on the first 10, but the next 10,000 you're going to pay 10%. Okay, so that's $1,000 of tax you would pay over the year. Okay, now if you instead earn $30,000, that next $10,000 would be at this higher bracket. Okay, so that would be at the 12% bracket range. Okay, if you earn 40,000, then that next 10,000 is at 12% again. And if you earn 50,000, that last 10,000 you earn is also at the 12% bracket. Okay, so you would basically be paying $30,000 at 12%. So that would be $3,600 in tax on this amount. You'd be paying 10% tax on this $10,000. That would be $1,000 of tax. And you'd pay 0% tax on this. So you'd be paying a total of $4,600 of tax if you earned $50,000 this year. That's pretty good. That's about a 9.2%, what we call effective tax rate. And your marginal tax rate would be here at the 12%. Okay, so the US tax system heavily favors people who are single and earn $50,000 or less, basically kind of like the average American income. The average median family income is around $57,000. If you're earning $50,000 or less, you're paying less than 10% of your money to federal income tax. Now, you still have to pay Social Security at 6% and Medicare at 1.5%, but that's separate from the federal. And if you live in a state with state tax or a city with city tax or a county with county tax, then you pay those as well. But from the federal side, you're paying less than 10% tax on the first $50,000 you earn. Okay, so this is actually a pretty good place to be from a tax perspective. Now, there's a big jump. After you get to 50,000, you are jumping up into the next tier. I changed colors because then you're getting up into this 22 to 24% range. Okay, so basically your tax rate has doubled. Okay, so I consider this basically low, medium, and high taxation. Anything in the 0 to 12%, I would consider low. Up here in the 20% to 25% range, call it medium. And then anything over 30%, I would consider high. Okay. Now, if you earn 60,000, that last 10,000 is at 22%. This one's at 22%. This one's at 22%. And this one's at 22%. So if you've earned $90,000, the last 40,000 you earned was all taxed at 22%. And if you earn 100,000, then you're bumping up here to the 24% range. Okay. And so you're spending a lot more money here in tax. The first 50,000, you only paid less than $5,000 in tax. But from the next 50,000, you're paying over 22% tax, because you have 22% on this and then 24% on that. So 22% of 50,000 is going to be $11,000. Okay, so $11,000 on the second 50 and only less than 5,000 on the first 50. So you're more than doubling the amount of tax from going from 50,000 to 100,000. Okay, now this 24% bracket, I actually made it span 2 frames, and you'll get that in a little bit. Okay, but the 24% bracket goes all the way up here for the next 10, 20, 30, 40, 50, 60. So basically, if you earn 50,000 plus 40 is 90,000 plus 70 up to $160,000 as a single person, you are just filling up the low and the medium tax brackets. Okay. When you get over 160,000, that's when you get bumped up into the high zone at 32%. Okay, and the first $50,000 you earn there is taxed at 32%. Okay, now after that 32%, then you jump into the 35% range. Okay, and you do that for a whole $100,000. Okay, so that's basically from 210 to $310,000. That entire range of 100,000 is taxed at 33%. Okay, so whereas the first $100,000 you earned was taxed at like 5% plus 11,000, so 16%. This $100,000 is getting taxed at 35%. Okay, or 32 and 35%. And then when you get past 310,000, the very bottom, you can't really see it well. This very last row here is 37% bracket. Okay, so that takes you from 0 all the way up to 37% for a married filing single person. Somebody who's single only and not married, this 35% bracket actually is even longer. It goes from 210 all the way up to $510,000. And then the 37% bracket doesn't come in until after 510,000. Okay, but here's married filing separately: 0, 10, 12, 24, 0, 10, 12, right? Okay, then 22, 24, 24, then 32, 35, 35, 37. Okay, progressive tax, 8 brackets. Now, if you are married filing jointly, this is relatively simple. Okay, sorry. If you're married filing separately, one spouse would have their income and go through the brackets, okay, and pay the tax. Then the other spouse would put their income and pay the tax. So let me show you 2 spouses who are doing married filing separately. Let's pretend that one spouse earns, I'm gonna say $30,000, okay? So 10, 10, and 10, okay? 10,000 at 0, 10,000 at 10%, and 10,000 at the 12% bracket. The other spouse, let's say, earns $100,000, okay? So I'm going to do these brackets in the opposite direction, okay? Now, the other person also gets $10,000 at the 0%, $10,000 at the 12%, sorry, yeah, $10,000 at the 10%, then $10,000 with 12%. Okay, so the first $30,000 for each person is taxed exactly the same. But now the next $70,000 that the other spouse earns, okay, was $10,000, $20,000, $30,000, $40,000, because we have $40,000 of space over here, okay, at the beginning of the 22% bracket. Okay, now there's another so 10, 20, 30, 40, 50, 67. There's another $30,000 of earnings this person has. So this last $30,000 will be here at the 24% bracket. Okay, so the first person was taxed at 0, 10, 12, but the second person was taxed at 0, 10, 12, 22, and 24. Okay. You'd calculate how much tax each of those is for the two parties and you add them together. And that is their total tax that is due for the two people. Now, if they filed as a married couple jointly, then with the current tax system, it's very simple. Each bracket basically just doubles in size, okay? And so what would basically happen is you would say, okay, the couple earns $130,000, okay? So I'm gonna go back and reset this, okay? And then they earn 130. So 10,000 from here, but it gets doubled in size because they're married jointly. So 10,000 and 10,000 is 20,000, okay? Then 10,000 and 10,000, okay, now we're up to 40,000. They have $90,000 more earnings. So they have 10,000, 10,000, 10,000, 10,000, 10,000, 10,000. So this is $100,000 of earnings. They have $30,000 more that they've earned. Okay, so I'm just going to fill up 10, 20, 30. Okay, so all of this here in the middle has to be taxed. These 20,000 at the top will be taxed at 0%. Okay. This 20,000 here will be taxed at 10%. This 60,000 here will be taxed at 12%. And this 30,000 here will be taxed at the 22% bracket. So if you notice, they never reach the 24% bracket when they file married jointly, because they get to use up all of the space in each bracket for both parties before going to the next row. Okay, so this taxation is no more, it's never going to get to the 24% bracket. So we know that it has to be less than married filing separately when the first person only earned 30,000 and the other person earned 100,000. We had 10, 20, 30, then 40, 50, 60, 70, 80, 90, 100. Okay, so you see the difference here is we have three of these guys at the 24% bracket. And so because you're bumping the $30,000 up a level, there will be extra taxation. Now, it's not going to be much of a difference because 24% and 22% are very similar, right? They're only 2% different, and 2% different on this $30,000 is only $600. So it's not a big deal, okay? However, if it was bumping us up to the 32% bracket instead of the 22% bracket, then that's a big shift in taxation. So the 22 and 24 are basically like twin sisters in terms of taxation, the same as the 10 and the 12. Like they're so close together, I don't even think of them as really being different, okay? Now, this can become a very big problem when one earner earns a lot and the other earner earns little, okay? So for example, let's say one person is a physician specialist and earns $300,000 and the spouse earns only, let's say, $30,000, okay? And they decide to file separately, okay? Well, the same $30,000 is here for the first person, but then, actually, you know what? Let's do it the other way. Let's make it a little bit easier. We get 10, 20, 30 for the first person. Now the other person earns 300,000. So 10,000 at 0, 10,000 at 10%, 30,000 at 12%, 40,000 at 22%, 40,000 at 24%, 30,000 at 24%. So that's a total of 30, 70, 110, 140, 150, 160. Okay, so the person then has another 140 to earn. That's these 5 right here, and this is at the 32%, 5 here at the 32%, or sorry, the 35%, and then I don't know how many I had left. I think I had 4 left at the 35% level. Okay, so let's count that again. 1, 2, 5, 9, 13, 16, 21, 26, yeah, 30. So $300,000 goes all the way down here to the second to bottom row, all the way to the 35% bracket. Okay, if they filed married at $330,000 jointly, this would save them a lot of money. Okay, $330,000 if they do it jointly, okay, is doubles all the bracket sizes. So you have 20,000, 20,000, 60,000, that's 100, 180, 260, 320, and then basically then 10,000 more. So we're just touching here the 32% bracket. Almost all of the money would be taxed at 24% or less, and only one of them would be getting taxed at 32%. So this is an incredibly large tax savings by filing jointly. Okay, so that is the primary difference. In general, there's no way to save money on taxation if you're married filing separately. If you're both taking the standard deduction, it's not really going to happen. Okay, now you could file married filing separately and it might not be any worse. Okay, if both parties earn the same amount of money. Okay, let's pretend both parties earn $50,000. Well, $50,000 on each side would be the exact same thing if it's joint or separate. Okay. It's also possible that they could be substantially different incomes and still be exactly the same. Let's pretend that one person earns $90,000 and the other earns $50,000. Well, they both filled up the 0, 10, and 12% brackets, and the next $50,000 all would get taxed here at the 22% bracket if they're filing separately. But if they're filing jointly, it would just be like this. Instead of all 5 of these, oh, sorry. Okay, let's pretend they earn $90,000 and $50,000. Okay, this extra $40,000 would all be at the 22% bracket if they're separate. If they're joint, it would be like 20 and 20, both again at the 22% bracket. So it'll make no difference. So you have to look at how different the incomes are. And they could be, as long as the difference is within one bracket, it may make no difference at all. Okay, so if, for example, this person here made 90,000 and then this one made 130,000, again, it'll make no difference because this extra $40,000 is the same if it's coming from one person or if it's coming from both people. Okay, so as long as it doesn't push them down an extra bracket level, there's no difference. Okay. Now, there are some penalties you take for married filing separately, in addition to having potentially higher taxation. There's a long list of them, but one of them is you can't contribute to a Roth IRA directly. It's not that big of a deal. You can go in by the back door if that's open and you don't have any pre-tax IRA money. Okay, you can't take a deduction on a traditional IRA contribution. This doesn't affect a lot of people who are working with income at a job that has another retirement plan because you're otherwise often disqualified. Okay, but a lot of people with lower incomes can take a deduction, for example, if they're not employed. Okay, now there's 2 big ones, or one big one and one medium one. The student loan interest deduction. Okay, this phases out after your income is a certain point. Okay, like 150,000 if you're married, and like half of that if you're not married. I don't know the exact numbers, but it's around there. If you're paying student loan interest up to $2,500, you can deduct that. And it's called an above the line deduction, which means you don't have to itemize anything to claim that deduction. But it only is deductible if you are married filing jointly. Okay. If you're married filing separately, that gets thrown out. Now, that's not even necessarily that big of a deal, okay? If you're only earning $150,000 as a married couple, you're only getting into like a moderate tax bracket, okay, in the 22% range or less, which means 22% deduction on a $2,500 $100 deduction at 22% tax. That's like $600. Not a huge deal. But what is a big deal is the child tax credit. And that's something that in 2018 is a big deal because most people with high incomes got phased out of that before. But with the new tax laws, they don't have an exemption anymore for every person. They increased the standard deduction and they also gave child tax credits. So that's like $2,000 per child as a credit. That's literally $2,000 back to you on your return per child. Okay, so a $2,000 credit, if you're only at the 22% bracket, that's like having a $9,000 deduction. Okay, that's a big deal. So that's a lot bigger than the student loan interest deduction. Both of those two things, the child tax credit and the student loan interest deduction, you cannot claim those if you marry filing separately. What is the one big reason why married filing separately can be very helpful for a lot of people right now? That's if you are, for example, in residency or fellowship and training, and you have a bunch of loans, you have like $300,000 of student loans, and you're on an income-driven repayment plan. In particular, if you're on pay as you earn, PAYE. PAYE, pay as you earn, allows you to make your payments based on your own income if you file as married filing separately. Okay, so if one person only earns $50,000, okay, I'm going to put that person over here on your right side. That's the resident. And the other person, let's say, makes 50, 90, 130, 160, $200,000, okay, they're going to pay a lot more tax. But when you file for your income-driven repayment plan with PAYE, with pay as you earn, they only base it on your income, and they subtract like 1.5 times the federal poverty rate for your family size. So basically, if you have a $50,000 income, your monthly payment might just be a couple $100. Okay, you might be able even to put money away into like a pre-tax 403b, 457, and bring your income down to like $20,000. At which point you might be at the federal poverty limit, and you could bring your income-driven payment like basically to zero. Okay, so it can bring your loan payments down really low, but you're not keeping up with the interest, so it's likely going to have an increased principal or increased total value over time. But if you're eligible for public service loan forgiveness and your loans are going to be wiped away anyway in the future, it doesn't matter how much the balance is as long as it gets forgiven. Okay, and if you're going to have your loans forgiven, you want to pay the least amount. Okay, student loans and income tax are basically one and the same. They're both going to the same place. Okay, so if you do married filing separately, you can keep your loan payments super low, but you may pay higher tax. Okay, and it's going to the same place. Okay, so every year you should do your calculations and decide how you want to file and see how that works with your loan payment plan. You may want to change your loan payment plan, and that has some issues with it too. Okay, but you could potentially save like over $1,000 a month, or more than, multiple thousands of dollars a month just by doing married filing separately on your student loan payment. But you might be paying thousands of dollars extra, multiple thousands extra when you file for your taxes. Okay, so you have to be very careful and plan both of them out. Don't just plug in the loan calculator how good it would be if you did pay as you earn married filing separately. You have to also calculate your taxes. Okay. Also know that child tax credit, you're going to lose that. The student loan interest deduction, you're going to lose that with married filing separately. So you have to do all of these calculations, and that's a lot of work, and you need to do it every year. But this is so important. This is way more important than trying to clip coupons or do things like these. Are big things you can do that have a very big impact on how much wealth you can build. Because if you're saving yourself thousands of dollars a year, you can invest thousands of dollars a year extra. You save an extra $5,000 a year over 30 years, that's easily like $1 million with historical returns. Okay, so it's nothing to not be cognizant of. And there you go. Married filing separately and married filing jointly. Okay. It's really not that complicated, especially with the new tax laws. The old tax laws had brackets that weren't basically doubled. So there was what we call a marriage penalty. That's basically gone. Okay. We used to pay like $30,000 a year just to be married. That's a lot per day to be married. Okay. So actually, yeah. Getting married, the wedding portion was actually not very expensive. We thought it was at the time, and then we realized we're paying $30,000 a year because we got married. But now that penalty is basically gone. So that's like an extra $30,000 that we can invest every single year now with the current tax system. All right, so that's it for today. Say hi again to everybody here. Bantu, Chris, Julie, thank you for joining. That was episode number 20, Taxes episode 6. Hopefully by this weekend, I'll have my studio, my office set up here. And so I will be able to do more episodes more frequently again. I'd like to do at least 2 a week going forward again, because these are fun and I have so many topics to discuss. So if you have any suggestions, please send me a message and I will try to address it in another episode. And until that time, where did she go? All right, here we go. Pinky, take us away from episode number 20.
Hey, let's get moving.